anytime you look at a stock to potentially invest in, there's going to be two major categories. The quality of the actual underlying business. So this is their market share, their growth, are they being innovative, how's the management team? All that kind of stuff is super important. And the other half is the valuation of that asset. Because you could have the highest quality business in the world, but if it's priced to infinity, it's still not going to be a great investment. So in terms of identifying high quality businesses, there's many ways to go about doing this. One of the best is to simply screen peek on other successful investors like Warren Buffett, see what's in their portfolio, what do they invest in, and then use that as a base to do further research. In this video, I'm going to use SCHD as that base because this is widely considered to be one of the best dividend ETFs on the market. So thus, it should have some of the highest quality dividend companies within it. And at the moment, the top dividend companies according to SCHD are Broadcom, Verizon, and Merck & Co. Okay, so that's step one, identify a quality business. And once you have those, you have to apply hopefully an accurate valuation to those assets to see if they're expensive, cheap, or what. And in this video, because we're talking about dividend paying companies, I want to apply the dividend yield theory to these companies and their valuations. So the dividend yield theory is very simple, and that's one of the things I love about it. And it basically says that for blue chip dividend stocks, aka those with stable business models, the dividend yield tends to revert back to the mean. So using SCHD as the example here, of course, when the price of an asset goes up, the dividend yield goes down. There's an inverse relationship between the two. But you can see here with the historical dividend yield of this asset, it likes to be around 2.9%. And that's because at its core, both the price of an asset and the earnings it can pay is directly tied to the earnings of the underlying business. I'm sure you guys are familiar with the PE ratio. This is a multiple applied to the earnings of a company to give it a price. So if a company increases their earnings by 10% per year, ideally, if the PE ratio remains consistent, the price chart should look like this, go up 10% per year. And if it's a dividend aristocrat, a company that pays consistently growing dividends, that means to maintain a consistent payout ratio, say 50%, they can increase their dividends by 10% as well. But sometimes there's a disconnect between the earnings and the price of an asset, and that's what this strategy allows you to identify. So again, for SCHD, let's say the dividends are growing by 5% per year, the price is growing by 5% per year, and that's why the yield is always around 2.9%. But sometimes, like back in March of 2020, when the price crashes, but the actual underlying businesses are fine, the dividend yield will spike above its average, and this could be a great indicator of a potential good value. And eventually it will revert back to the mean, meaning that the price has to catch back up to the earnings. And it's the same exact concept with the PE ratio. Here we can see the earnings growth of the S&P 500. This is the price of the S&P 500 over time. And this is the historical PE ratio. And using the revert back to the mean strategy, we can easily identify bubbles and potential discount opportunities. But just like with any strategy, this is not foolproof. It is just one potential tool you can use in this kind of evaluation scenario. Okay, so using SCHD to identify the value dividend companies for us, let's apply this valuation method to these companies, beginning with the number one holding, which is Broadcom at 4.42%. So this right here is the net income of Broadcom, and it has a 5-year annual growth rate of about 30%. Now, keep in mind that spikes in the data like this can mess things up, but I'm just using this as a rough average. Now, the company has also increased their dividend by a very similar amount every year, 28.5%. And in a perfect world, that means the price would also go up about 28% per year, but it only went up 18.5% per year. And that's why when looking at the historical dividend yield of Broadcom, the yield is now higher than it was 5 years ago. Of course, we can tell that right now is not the absolute best time ever to buy this company. Back in about October was better, and March of 2020 was the best. But if we draw a rough average, the dividend yield of this company likes to be around 3%, which is right where it is right now. So all else being equal, just using this method, I would say Broadcom is fairly valued, if not a little bit more attractive than usual. And to help us confirm this, we can use a ranking site like TipsRank, and they also give a strong buy rating to Broadcom right now. It's not completely positive, so we do have some insiders selling shares. Crowd wisdom is very negative, but hedge funds are buying more. Blogger sentiment is bullish. and the general consensus is a strong buy. The next company on SCHD's list is Verizon. So Verizon is a much slower growing company. In fact, because of this spike in the data, their 5-year annual growth rate is actually -6%. And somewhat poetically, the 5-year average growth rate of the price of the asset is down a very similar amount. Now, Verizon has been ever so slightly growing their dividend at about 2% per year. So based off of this data and the historical yield of the company, right now is a great buying opportunity solely based off of this valuation model. The average yield of this company is 4.8%-ish, and right now it's 6.5%. But before you run out and buy this company, remember the other half of this equation when evaluating stocks: the quality of the actual business. And this is the main reason why Verizon is so cheap. People are questioning the quality of the business. But according to SCHD, this is their second biggest holding, so they have some confidence in the business model, at least for now. And coming back to this ranking site, the general consensus on the internet is a moderate buy. And let's test out this theory one more time. So the third biggest holding of SCHD is Merck & Co., a large pharmaceutical blue chip dividend paying company. So Merck & Co has pretty solid growth in their net income as of very recently, the past 5 years, which just so happens to be when I took this data. They grew their dividend by 9.2% per year, and their stock price went up a little bit faster than that at 12.8%. And as a result of that, when taking a look at the historical dividend yield, it seems like right now isn't the best time ever to buy this company. The average dividend yield for this company is about 3%, and now we're sitting at just over 2.5%. Back in 2021, when tech stocks were rising and nobody cared about large, stable blue chip companies, that would have been the much better time to buy into this asset. Now, of course, the quality of the actual business could be well above average. They are growing their net income extremely fast, and maybe that's why they have a strong buy consensus, even after the most recent run-up in the price. So there you have it, guys. That's how you can use the historical dividend yield as well as the historical PE ratio to value various dividend companies. It's a very simple process, but sometimes those can be the most effective. Let me know what you think of it in the comments below. If you're still watching and enjoyed, leave a like, subscribe for more, and I'll see you guys in the next one.